Investing in oil wells. Since its discovery, crude oil, also known as black gold, has become an essential part of our lives. Almost everything seems dependent on some product from the petroleum industry, from transport to energy to fabric. As oil prices continue to soar once again across the globe, many people are tempted to invest in the oil and gas sector, but don't know where to begin or if they should do this. This video will take you through all the options for investing in oil and gas and the pros and cons of putting your money in this industry. Different types of companies you can invest in. To start, let's look at how the petroleum industry operates and the different types of companies you can invest in. Upstream. Also known as exploration and production, or E&P companies. These are responsible for discovering and developing oil reserves into profitable oil production sites. This is a high-risk, high-investment, technologically intense, and long process, as it takes a lot of time to locate and drill oil wells that can be used to extract oil. The cash flow of these companies comes from the oil production. The entire process before that is all costs. Downstream. Downstream companies include oil and gas refineries as well as petrol stations. Refineries produce several products from crude oil, such as gasoline, asphalt, jet fuel, and heating oil, while petrol stations directly serve the end consumer by providing refined car fuel. Midstream. The main purpose of these companies is to transport extracted raw materials from oil wells to oil refineries, where they can be processed. This is achieved through pipelines, shipping, trucking, and storage. These functions are highly regulated due to the safety concerns involved in transporting oil and gas, and the success of profitability of these companies depends entirely on the success of upstream companies. Integrated. These companies integrate two or more stages of oil and gas production, making them some of the biggest corporations in the sector. More control over the start-to-end process allows these companies to be more efficient and diversify their revenue generation sources. However, due to the humongous amount of capital required, the barrier to entry for this type of company is very high. Some of the biggest names in the oil industry, like Chevron, BP, and ExxonMobil, are integrated companies. For this video, we'll focus on integrated and upstream companies involved in the discovery and development of oil wells. Now that you know the basic structure of the oil and gas industry, let's get into the main point of the video: how to invest in this industry and whether it is a good time to do it. Oil as an asset. Despite its volatile nature and continuous price fluctuations, it is clear that oil production and its consumption are not halting anytime soon. Even during the COVID-19 pandemic in 2020, when most of the world was on lockdown, around 91.9 million barrels a day of oil was being consumed. So, oil remains a lucrative investment option, and several tools have been created to predict oil price trends. One such tool is oil futures, our first way to invest in oil and gas, which we will discuss in this video. Different ways to invest in oil wells. Oil futures. An oil future contract is one person selling risks to another who hopes to get profit when the risks pays off. For example, say a commodity is currently selling for $20, but is estimated to increase to a price of $30 3 months later. But a spectator in the market believes it'll be much higher, so they enter a contract to buy the commodity at the $30 rate when that time comes. If the product sells for $40, they make an instant $10 profit. Of course, things could go south as well. This isn't a cheap investment option though, because you will not be investing by the barrel, but by the thousands of barrels, and will have to potentially wait till the contract matures to see if your investment paid off. Spot markets. This is a great option if you're sitting on a huge pile of money and have the capacity to store the oil you are buying directly. And when we talk about storage, we're talking about shipment with at least 600,000 barrels or around 25,000 barrels coming in monthly via pipeline. That is how huge the scale of this investment is. Of course, it's also extremely profitable, given a good price trend. Energy stocks, mutual funds, equity EFTs. Investing through stocks or mutual funds might be your only option if you don't have a huge lump of money. Most of the big names in the oil industry offer stock options. These include oil super majors like ExxonMobil, Royal Dutch Shell, BP, Chevron, and Total Energies. Needless to say, they aren't going out of business anytime soon, with average revenues of more than $100 billion, so they can be really safe investments. The same can be said for large exploration and production companies, such as ConocoPhillips. Given how quickly oil prices can nosedive, Smaller companies are much riskier investments because they can go bankrupt in times of price decline due to the level of operating cost. However, just because big companies stay in business doesn't mean price fluctuations won't impact their stock. The biggest benefit of buying oil stocks compared to other investments is its higher dividend yield. ExxonMobil, for example, had a dividend yield of 4.5% as of March 2021. On the flip side, investment in oil stocks can be risky for a variety of reasons. There is uncertainty about a company finding new reserves during exploration and being able to produce consistently. Since this is a cyclical industry, investors will face both booms and busts and have to time their investments well. Oil's highly flammable and toxic nature can cause disastrous consequences of accidents during transport or in the pipeline. For example, the Gulf of Mexico spill in 2010. Equity Direct Participation Programs. A DPP is a pooled investment used to invest in multiple oil wells over a several-year-long period. Once extraction starts after drilling is done, investors start receiving monthly dividends. The tax exemptions for the company are also extended to the investors. So, you can get a tax write-off for up to 85% of your investment. 15% of your income from the well is also exempt from taxes. After a few years, the wells in the package are sold to a larger company, and the money from the sale is distributed proportionally among investors. The profits from the wells can be very handsome. However, they are subject to success in drilling. Therefore, if the drilling can't find enough reserves, you might end up sinking your entire investment. Some of the ways to invest in the oil and gas sector are mineral rights leases, mutual funds, ETFs or exchange-traded funds, ETNs or exchange-traded notes. Advantages of investing in oil and gas: capital gains. Just as price volatility can mean losses, as we have discussed throughout the video, it can also mean huge gains. The cyclical nature of the oil and gas industry means you can earn a lot from buying low because there is a promise of higher prices in days to come. Many people who bought oil when prices hit rock bottom during COVID are now reaping their rewards. Portfolio diversification. Often, oil and gas won't have a strong correlation with stocks and bonds, as it is a good idea to diversify your portfolio using such commodity investments and hedge against stock market ups and downs. The start of a supercycle. Many claim that the soaring of oil prices is the start of a new supercycle, and that prices will go further due to demand and structural changes. Energy demand. Oil remains the main source of energy production across the globe. No alternate source has shown the level of energy production per unit that oil has. With a growing population, oil won't go away anytime soon. Risks in investing in oil and gas. Geopolitical issue. Political shifts can appear out of nowhere and cause dramatic fluctuations in the oil industry. The recent Russia-Ukraine war and the resulting energy and fuel crisis show us that. Geological risk. While the Earth's oil reserves are nowhere near finished, they are moving in that direction. They are also not easy to find or extract, making exploration and production a very risky business. Supply and demand risks. The COVID-19 pandemic showed us how quickly oil demand can drop and its huge impact on investors. Moreover, the trend toward green energy and EVMs will further reduce the demand for oil in the coming decades. Operational costs. The operational costs of oil and gas exploration, production, refinement, and transport are humongous and can cause a significant dent in earnings. Do oil and gas have a future? While climate change has forced many countries and corporations to try and look beyond oil and gas, it will be a few decades before clean energy can reach the efficiency of energy produced via oil and gas. Till then, it will remain high in demand across the globe. Moreover, when talking about oil wells, it's important to remember that petrol is not the oil product produced. Crude oil remains an integral part of the production of plastic, fibers like polyester, and petroleum jelly that are used in many different ways. We are nowhere near completely halting oil wells. Should you be investing on your own? Given the nature of the industry and the importance of timing your investment well, unless you want to lose it, and the plethora of investment options available to confuse, it's much better to consult a professional financial advisor instead of trying to DIY it. So, you can take advantage of this industry while it lasts and add some great investments to your portfolios.